put you on the map. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas, Nevada. And folks, we always talk about Reg.A and how Reg.A is such a great tool to use for companies that are looking to go public, get on an exchange, get on a major market. Today we're going to take that to another level and go over some of the problems that these companies may be facing. And before we do that, let's introduce Vicky Hutchmala from the World Token Market. Vicky, how are you doing today?
Oh, another fabulous day in Vegas, Ron. How could I not be fabulous as well?
I know, right? There's a lot of issues out there who are going to really take the information that you're going to get today to heart, because it's one of the biggest topics right now. Everybody's looking to raise money. Everyone's looking to get their fund listed, and what do you do once you're there? So let's get into this whole thing. Let's introduce Mike Brette. Mike is the CEO of Small Cap Equity Advisors. He's been on the show many times already. Everybody knows him. Mike, welcome back. How are you doing today?
I'm doing very well. Thanks for the opportunity today.
Always a pleasure. Always a pleasure. You are keeping busy these days, Mike, aren't you?
Yes, we are. Yes, we are. We're working in a new sector for us, which is in the Reg.A plus area, specifically for publicly traded companies, OTC companies, NASDAQ, and NYSE companies that are public and have a qualified offering with the SEC under Reg.A. And my partners and I, we got together in the last couple of 6 or 8 weeks, and we pooled our money together to form a fund to actually write a check if the company qualifies and stop them from getting involved with these toxic lenders with a death spiral and just ruining companies and shareholder value.
Yeah, so let's go through the process on how this thing works to begin with. First of all, to do the Reg.A, they have to file their documentation. They get the Reg.As back. They get approved by the SEC to do this. And then at that point, they get listed on an exchange?
Yeah, they can either do it in that fashion, or they can already be listed on OTC markets, or OTC over the counter, or NASDAQ, or New York Stock Exchange. They're already public. Now, traditionally, OTC companies have only had access to the capital market through toxic convertible notes. And these toxic lenders have just ruined companies because they lend money to the company at generally a 50% discount off of where the stock trades when they enter into the agreement. And then if there's any defaults or certain trigger points in the agreement, it allows these toxic lenders to convert their notes into tens of millions of shares, and then they immediately sell that stock into the market and push the price down farther, which then allows them to convert more notes at a lower price. And so there's what occurs is a death spiral. The stock just goes from down. I've got one client now we're trying to clean up. I won't give the name right now because we're in the middle of it, but 8 months ago, the stock was $3.90. Today it's 10 cents because they entered into a series of those toxic notes and just hammered it. So now, having said that, is kind of prefaced everything. What my partners and I have come up with is we put together our own money in a fund. So if an OTC company is trading, and then they've taken the extra step to get a Reg.A Plus qualified through the SEC, we will take a look at that, look at some, the trading history, do some due diligence, and then we will write the check. We'll write a check for $250,000, $300,000 in increments, up to maybe $5 million, $7 million, depending upon the liquidity into the stock, the trading history, and a lot of things moving forward. What we're hoping is what like to see is when we fund these companies, they're putting that money to use to grow the company, the stock price increases, the market cap increases, and the trading volume increases, and shareholder value increases as well. And so we're filling that void with all these toxic lenders really hurting companies, and the SEC has been coming down hard on these toxic lenders, taking them to court and claiming that they're acting as an unlicensed broker-dealer. And so they're preventing them from doing any more conversions and making any more toxic loans. And even the transfer agents are stepping up now and refusing to convert these shares under those kind of toxic environments.
Yeah, how prevalent is this problem? I mean, does this happen to a lot of companies, or is this just
yes? No.
Yeah.
A good question. It happens to probably 70% of the companies that are listed on OTC market. I mean, it's horrendous what happens to these companies, because a lot of them, they get sold a bill of goods by some shell broker that says, look, we'll sell you a shell, take you public, and raise you $10 million. And these companies really have no business going public first place, some of them. And they buy into that scenario I just painted. And now they got a stock symbol. They're trading on OTC for a penny or 2 cents. And they can't pay the rent. They can't pay employees. They can't pay overhead. They can't get their prototype or their products to market. And lo and behold, one of these toxic lenders, starts cold calling and finds them, and then says, okay, this is what we can do for you. We'll give you a $10 million commitment. And they outline the terms, and they start usually with $50,000 or $100,000 at a 50% discount, and it just goes on and on and on, just like I described. So it's usually happening to companies that are hard pressed for money. They can't go anywhere else to get financing. Their company, institutional money is not interested because they're not over $5 a share. So they fall prey to these toxic lenders. It's really a problem, and I'm glad to see that the SEC and FINRA and the other organizations are finally taking it seriously and holding these people to task to help out companies. But in doing that, they've made it harder for companies, whether they're OTC, NASDAQ, or even NYSE. It made it harder to access the capital markets, especially for OTC companies.
Are these companies that you're talking about, are they larger companies, smaller companies, or are they just a composite of any company?
Well, it's usually a composite, but it's mostly companies that have very little revenue going for them. All they really have going for them is that they're a trading vehicle, and the toxic lenders don't really care if you've got a business or not. As long as they can get a bunch of shares at a 50, 60% discount and keep converting and selling into the market, that's really to care about. The more sophisticated companies that have established, revenue of $2 to $3 million, sometimes they fall prey to it. Other ones, have gotten into it, but they were able to pay off the notes before the conversion could take place. But it's still a major problem, and it's probably going to be a major problem for another 12 months or so.
Oh, wow. So once you approve a company and help them out, issue them whatever amount of funds that are necessary, then do you follow up after the fact? Do you advise them do you help them to do better marketing or better financial planning or whatever it is that they need afterwards so that they don't get back in that same position?
Absolutely, because it's our money at stake. So we make sure that we handle the investor relations, the public relations, the marketing, and we make sure that they don't take any toxic notes or toxic financing from anybody. So we work with them as a financial partner, as a marketing company, and we tell them, look, if we're giving you $500,000 and then funding incremental as your stock price increases, and if we're risking our money, we want to make sure you don't get involved with the wrong IR company or that does a pump and dump, or you fall back to your old ways and get toxic financing that's going to hurt our position. So we make sure that we handle everything from A to Z, and we stay involved with the company. As long as they're coming back to us for additional financing, we're right there. We don't write them a check and just say thank you very much and let them fall victim to anybody else. We stay with them.
So it's really to their advantage to come to you and to help them out down the road.
And then we try to uplist them too. We want to get them off of the OTC markets and get them, if they can qualify, meet the requirements of NASDAQ or New York, we want to get them up to the major exchange. And there are certain requirements, which I won't go into a lot of them on this show. That could be another show topic. But if we can get them to the point where they qualify for NASDAQ, that's really where they can start accessing institutional type money, avoid all the shorting that goes on with OTC stocks. So again, once we step in and help, we want to work with the company long term to uplist them as well.
Oh, that's
going public like that is an expensive process. But what people don't understand a lot of times is that it's also very expensive to stay public, to stay on these exchanges. So I guess that's part of your strategy as well, right? You got to be able to pay the bills, and that's not cheap.
Yeah. No, it's not, and that's the one thing that a lot of these companies who end up going public over the counter, let's say as a pink sheet or as a QB company, they forget about the ongoing costs, and that's why a lot of them fall victim to this toxic financing. They have to pay, for audits, and they have to pay for, the quarterly reviews. They got to do annual reports. I mean, it takes about at a minimum $250,000 to $500,000 a year just to stay current with auditors and legal fees and filings with the SEC. So it's an expensive process, and these companies fail to realize that. They go public in the cheapest way possible, and then all the reports are due, and they have no operating capital, and they're scratching their head. What do we do now? And lo and behold, the toxic lender comes along and says, I got the answer to all your problems, and it just creates more. So, Ron, you're right. It's an expensive process to go public, and it's very expensive to stay public. And I always I've taken a number of companies public in my 25-year career, and I always tell companies there's only one reason to go public, and that's to raise money. And if you go public in the wrong fashion, you'll never be able to raise capital, and you defeat your purpose in going public.
Well, a lot of it seems to have to do with bad planning in the first place. And if your ducks aren't in a row to start with, they're going to all fall apart as you go down the stream.
Excellent point. And you're right. I don't know how many calls I get on a weekly basis. I mean, it's been going on for years from companies that are startups with no revenue. And, they see things on CNBC, they read articles in the Wall Street Journal about, a startup that went public and the owners are billionaires. That's not really how it happens. That's an exception to the rule. But I'll get a call from a startup, and they've heard about a shell broker talking to them. Well, I can sell you a shell, get you involved, and you can become millionaires. And I'm saying, look, guys, it doesn't work that way. And when you bring the reality into the picture, the light bulb goes off, and some of them realize that other ones don't want to hear the truth. So they'll go someplace else, and they'll get messed up, and then they'll call me about a year later and say, hey, we should have taken your advice, and now we're in a real pickle. Can you help us? And usually the answer is no.
Well,
it's sad.
Right. At that point.
Yeah.
But I guess it's hard to turn down that phone call when you say, hey, you know what, I'm going to solve all your problems. I'm going to make you a multimillionaire. I'm going to put this company on the map and everything. And you just don't. I mean, it sounds great, right? So people take the call, and they fall victim to it a lot of times.
Yeah, and they all want to be. They all think they're going to be the next Mark Zuckerberg, Facebook, or whatever, and they buy into that hype. And again, those are exceptions to the rule. And Vicki made a good point. They just don't sit down with a team of advisors. They don't have the money to hire a securities lawyer, accountants, consultants, advisors, to really walk them through the process of going public. And they ended up going public in the wrong way, and then they're stuck, and they don't know what to do, and they hurt a lot of people, themselves included. So, again, we've stepped up, with my partners and I, and we're filling that void to help companies, that are real. We don't take on anybody that doesn't have a solid business and generating revenue and has a plan to scale their business up. Because, again, we're risking $200,000, $300,000, $400,000, $500,000, maybe a couple of $1 million of our cash, our capital. Well, we're not charity. We want to get a return on that, and we want to grow a company. So a company has to have some reality when they come to us, or we just say, come back to us when you meet our requirements.
Well, and if you don't, I don't know why it isn't just a no-brainer for people, for entrepreneurs, for business people, that if you don't know what you're getting into, you probably shouldn't get into it, because 6 months or 12 months down the road, you're going to come up to a huge obstacle that may just overturn your boat, and you'll have nothing left because you didn't not only plan for what you're doing, but anticipate the possibilities of what might happen and be prepared for them. It's like, to me, that's a no-brainer, but evidently there's a lot of companies out there that don't understand that concept.
Yeah.
Again, it seems to, professionals like you and Ron and myself that, they shouldn't get themselves in these situations, but a lot of people make mistakes. They do things, whatever it happens to be, they do them for the wrong reasons, and they get themselves in a box. And again, it goes back to the point you made, Vicki. They don't plan. They're too focused on whatever software they're developing or whatever piece of real estate they want to build, or whatever their widget, gadget, or gadget happens to be. They're so focused on that, and they think they're so brilliant because they came up with a software package. They're so brilliant, they won't listen to anybody else. That's number one. Number two, again, it goes back to what I said. They don't hire advisors, securities lawyer, accountants. They really don't investigate before they take the leap. And it happens to so many companies. It really is pathetic.
Yeah, and even if you have the brilliant epiphany in the middle of the night to make the most fabulous widget ever, if you don't market as soon as you wake up the next morning and tell everybody what you're doing, it doesn't matter when you finally get it ready to market. If nobody knows about you and nobody knows about your fabulous idea, well, there you are with a fabulous idea and nobody's buying it because you didn't market it ahead of time.
Well, that's an excellent point, because marketing is so critical to the success of a public company and the Reg.A Plus offering. I mean, if you don't market the offering, under Reg.A they have what they call test the waters, which allows the company, before they get too far down the road with legal fees and accounting fees and things of that nature, they can test the water by advertising their product, advertising their company, advertising, doing press releases and public relations, TV appearances, podcasts like your show, and kind of test the water. Is the market ready for our product? Now, you can't solicit investors under that test the water concept that's built into Reg.A, but you can find out whether there's a level of interest from a number of people. So if you start getting responses to your TV appearances or your radio appearances or press releases, and you've got 1,000 people that say, hey, I really like your product, I'll buy the product, and if you go public, I'll be in line to buy your stock. Well, if you get enough of those people that express an interest, then when your offering is qualified by the SEC, you can go back to those people and say, hey, now we're ready to sell stock, and take your investment, and you followed us for a long time, you know about us. Then they start a dialogue. But marketing is so critical to the success of a public company. And again, that's why some of these companies fall prey to the toxic lenders. They understand they need marketing and PR money to get the stock moving, but they don't have it. So they borrow this money thinking it's going to, be the end all and be all, and it turns out to be a nightmare for them. So marketing is so critical, and that's what we tell people. Look, you need to get your volume up, you need to get your price up, you need to get attention to the company and the stock. We'll put some money in right now, but you got to get this thing moving, and we'll help you. But you can't just sit there and think things are going to happen.
That's a good thing, because not only are you stepping in to help the companies who have fallen prey to these toxic lenders, but you're showing them this is what you should do and how you should do it and why you should do it, so that this doesn't happen to you again. And now you will be successful, because not only are we going to lend money to you, we're going to help you to make the money back, primarily so you can pay us back.
Yeah. Well, that's a good point. We take equity for our investment. We'll take equity at a 25% discount. So let's say that stock is trading for $1 a share. We'll put our money in at let's say 20% to make the math easy. So we'll buy stock out of their A1 offering for 80 cents, but we won't resell it at 80 cents or 50 cents. We're going to go at the offer. So if the offer is $1 or $1.20, we're selling into the market gradually through our trading department in a gradual manner to get our money back plus a profit. So that's why we insist that the company continuously market, do PR to keep that stock price up. What these toxic lenders do, if they buy the stock at 50 cents and it's trading for $8 or 80 cents, they run the stock down and sell it at any price just to convert into more shares, driving the price down, allowing them to convert into more shares. It's tremendous how much money these people make in doing these offers. But we want the stock to go up.
Oh, yeah, because that's a genius that you've built into your product, that you will get paid even if and not impact the financial success of the company, but you're getting paid by your percentage in the stock. So, they do good and you do good and everybody's happy in the end.
Yeah, it builds a shareholder value. More shareholders come in, to the company, and they build additional shareholders that, if they want to bring them into the Reg.A offering as additional investors, they're welcome to do that. So it can be a win-win situation for everybody, if it's planned.
Exactly.
Again, I keep going back to your point, Vicki. Planning is critical on all of these elements that we've been talking about.
I think they call that strategy, but I'm not sure.
Yeah.
Well, Mike,
and the Reg.A, go ahead.
I was getting back to your fund, though, real quickly, is, your fund solves this issue, and it's a really great resource. But you mentioned before, earlier in the podcast, that you have to qualify for this fund. What are some of the qualification things that you guys are looking for a Reg.A issuer to take part of what you guys are doing?
Yeah, that's a good point. They have to be a QB company. In other words, they have to be full reporting with audited financial statements, because that's another requirement to do a Reg.A. You need to do a Tier 2 Reg.A with audited financials. We won't get involved with a company that doesn't have audited financials. So they got to be full reporting. They have to be current on all their SEC filings. We like to see $100,000 a day in trading volume and have it keep increasing up. And then we like to see at least $2 million in revenue that the company's doing, and we want to see a plan on how they're going to scale that revenue up and a use of proceeds and how they're going to use our investment capital. We want to see, if it's a product company, we want to see that they have an active fan base, we call it. People that are out there buying. If it's an energy drink, where is it distributed? How many people are buying it, drinking your energy drink? Is it easily accessible to people, to consumers? So we want to see that, and most importantly, strong management, strong, experienced management that have run public companies before. This is why a lot of these OTC companies get into trouble. They have management that have never been involved with a public company. They don't know how to run a public company, and they don't know what's involved with making a success. So we look to the management in addition to all the other elements I just talked about. And we look for the management that will devote the time necessary in working with us so we can work as partners to make the company success. So those are some of the basic requirements. Again, they have to be a QB company. They got to be full reporting and with current on all their filings. They have to have audited financial statements. We want to see $100,000 a day in trading volume. We want to see at least $2 million in revenue and a strong customer base.
Okay, and your fund is relatively new, right? You just kind of created this just recently, I believe, right? You said?
Yes, yeah. This that's a good question. This really wasn't available until late October, that the SEC passed the portion of the Jobs Act that allows reporting companies to use Regulation A as a tool.
That's
Prior
right.
to that, the Jobs Act was passed in 05 or 06 with Reg.A, but reporting companies couldn't use it. Well, in 2018, the SEC said, look, we're allowing reporting companies, they can use this as a tool to raise money. So it really didn't come into vogue until maybe about 8 or 9 months ago that it was available. So our fund is relatively new. I mean, we've been organizing it for about 9 months, but we just got it kicked off within the last, 4 or 5 months, and looking for and interviewing clients. So we're relatively new, and we think we're one of the first movers and shakers in this market to recognize this void of eliminating toxic financing and coming in with financing that acts like a partner.
I agree. Yeah, I mean, this is a really
that's really good
idea. Yeah, I like it a lot. It's really, really great stuff that you're doing on that. And now, how easy or difficult is it to locate these companies? Are you doing marketing yourself, or are somehow people getting in touch with you regarding this product, this new fund? I guess you're just doing podcasts, or how are you getting out there?
That's a good point. We're getting quite a bit of referral work from attorneys, from securities attorneys that have taken companies public, and they're looking for a new vehicle to access the capital markets. We get referrals from other like LinkedIn and different social media, again on podcasts like yours, and I really appreciate you giving me this opportunity. So, and then we reach out. If we see a press release that's been put out by a company, we get the stock symbol, we'll look at it, we'll contact them, we'll do a phone consultation, we'll start a dialogue with them. So the many different forms of marketing and outreach with these companies, to try to get a dialogue going with them.
Yeah, you got to find that press release that says X company goes from $3.90 a share to 10 cents in 8 months. You don't see those press releases, do you?
Yeah. Those are tough ones. Yeah,
so,
yeah.
Are you working with many companies now, or have you helped to turn some at least to the positive aspect in the 5 months that you've been operational?
Yeah. We've probably had about we probably take about 15 calls a week from public companies. Most of them don't.
That's quite a few, actually.
Yeah, but most of them don't qualify yet, but we keep them on our radar screen. They don't qualify for a lot of reasons. Again, they don't have audits that are current, their filings. Either it might be a pink sheet instead of a QB. So, but out of 15 calls a week, we might find 1 or 2 that we can get a dialogue on. And then it takes, if they don't already have a Reg.A on file with the SEC that's qualified, our attorneys can do that legal work for them, but that's a 3 to 4 month process. So we've got some in the pipeline, but we're just probably another month away from really getting a lot of them qualified, because we can't do anything with them until their offering is qualified from the SEC, and then that allows them to sell stock. So it's a time-consuming process, and we go through a lot of leads to find 1 or 2 that we can work with and help.
Well, and plus it lets the companies know that, whatever your dream is, it's not easy, and nobody's an overnight sensation. So they also have to invest their time and effort and listen to the advice that you're offering them so that they can turn around and become more successful. So you give them not only the funds, but you give them a whole lot of extra just knowledge equity to take them forward.
Yeah, and that's a good point also. We try to be advisors and consultants to them. If they don't qualify now, we tell them why they don't qualify for our capital at this point, but then we stay in touch with them to try to guide them down the process. We introduce them to our accountants to do their audits and to help them, along that line. We, try to advise them on, why they need to do certain things so that they can uplist eventually to NASDAQ. So we try to educate them, work with them, not talk down to them, but be the advisor they should have had when they started this process
Exactly.
of going public. We want to stay with them and try to nurture them. And build relationships. That's what we try to do.
Exactly.
Yeah.
Do you find that these companies are conducive to realizing that the time and effort they need to put into turn around, and that they're willing to do that, or are they just relatively lazy and say, I'd rather just go find another toxic lender?
Yeah, that's a good point. Most of them, I wouldn't say most of them, but a lot of them say, look, we need money tomorrow. We don't have 3 months or 4 months to file a Reg.A and do that. So they're so far down, beaten down, that they really don't want to listen to the process of what it takes. That's one segment of the company. The other segment of the company is they said, look, we're already a public company. We should be able to raise capital as a public company without doing the Reg.A. Yeah, you should be able to, but you're not. So there's an educational process of why they need to do this next step to be a Reg.A. But having said that, there are quite a few companies that are coming to us that have already filed with the SEC for their Reg.A. They've already gone through the questions and comments, and some of them are already qualified. So when we get in touch with them, they're already 75 or 80% to the finish line. So it comes in segments like that with people that are contacting us.
Yeah, that's interesting. You got it from all different companies and different people in different stages. But before we close this out, I just want to make one last point. So if I understand you correctly, if I have a shell company, for example, and there are tons of people out there trying to sell shells, it's hard to say.
Yeah.
Yeah. Was that a tongue twister?
Yeah, that was a little bit of a tongue twister. That's the kind of company that really you can't help, right? Those are people that are really not in your sweet spot. Is that right?
Yeah, I mean, we try to avoid that because typically it's a pink sheet shell, and we don't really do pink sheet, companies because they don't have the audited financials. So that's why we want to do a QB. And you're right, with that designation as a shell that the SEC came out, which means you don't have any free trading stock available. However, having said that, if it's a company that really has revenue, they have maybe some intellectual property, they have maybe they want to be a real estate investment trust, and they have some real estate. If they have some positive elements like that, that's where we can work with them in guiding them to the Reg.A to get their audits and to qualify for a Reg.A, and the Reg.A provides free trading shares through the Reg.A. It's a different class of stock that's issued under Reg.A, so we can help them out if they are a real company.
Gotcha. Okay. And then lastly, my last question, as far as this fund is concerned, how do people get a hold of you for the fund? Is there a website, or how do people get more information on the fund? Or, if they want to make an investment, are you looking for investments into this, or is we're not taking any outside investment because we handle our own, and we don't want any outside investments. But they can contact me directly at 951-236-8473. They can go to our website, which with my partner John Stoddard and I, he's one of the partners. There's actually 6 of us, but they can go to our website, which is investorattractionsecrets.com, and they can go up into the right-hand corner and click on OTC Fund, and they'll get all the information we just talked about on the show. So, and then they can email me or get in touch with me through LinkedIn. So my email address is mikebrette@gmail.com. Yeah, we'll have this all in the show notes like we always do. But Vicki, are you ready to start your Regulation A fund and everything? Is this incredible? This is pretty cool, isn't it?
This is cool. And you know what's nice, Mike, is you found a niche and you filled it, but you filled it with the purpose of helping companies who have been victims of toxic lenders or even toxic companies, ancillary companies out there that are using and abusing companies because of their lack of planning and because of their lack of education. But you're doing a good thing and you're helping companies, and that's a great thing. kudos to you,
it.
Mike.
Good.
That's fabulous.
Appreciate it. Good comments. I like that. Thank you.
Yeah, and thanks again, Mike, for being a guest on the show and taking time out. This is a really informative podcast. And like I said from the start, if you're an issuer, you're doing Reg.A, this is the podcast for you. You should be watching this podcast, listening to it over and over again, and contacting you because this is a big-time resource. And it's a big-time problem, which no one really has looked into up to this point. So this is a big score today. Thank you for your time. Appreciate it.
Okay, thanks, Ron. Thanks, Vicki. Appreciate it.
Yeah, and thank you, Vicki, for co-hosting this. It was great. And everybody out there, you're listening to the Mappable USA podcast over at mappableiusa.com. If you'd like, go to that homepage, scroll down, you'll see all our syndication sources, which, by the way, is about to grow. We're working on another syndication thing that's really, really cool. I'm really looking forward to this. I hope it happens, and I'll keep everybody involved in that, too, to let you know. But, we have syndicated. Go out there. Click on the link if you want to be a guest in the show. There's a guest tab there. If you want to be a guest like Mike was today, fill that out. We'll see what we do about getting on the show. If you want to make a comment on there, we're at info@mappableiusa.com, or just comment on the page you're listening to this on right now. So everyone, thanks for listening. Thanks for your support. We'll be at you next week with another Mappable USA podcast. Have a great week, everyone.